Hello everyone, this is Amir Amidian from FISG, and today is the first session of our trading bootcamp. You will discover at the end of this session how global economy can affect every single move in the financial markets. Let's have a look.
Greetings everyone, my name is Amir and I will be your instructor throughout this trading bootcamp. I'm so excited how you're all here, and I hope this course will completely change the way you're looking at the financial markets. Let's start with the first slide, or let's say the introduction. As you can see here on the screen, our team is from reading charts to reading the economy. That's exactly what this bootcamp is about. Many traders spend years focusing on charts, indicators, and patterns. While technical analysis is important, it's only one piece of the puzzle in that trading. Behind every major move in Forex, gold, stock indices, and other CFD market, there are economic forces driving these prices. The goal of this course is pretty simple: to help you become a more informed trader by understanding the economic story behind the charts. By the end of the program, you will be better prepared to interpret market events, analyze economic data, and make more confident trading decisions. So let's get started. I'm going to start this slide by a very tricky question. Why did the market move against me? This is the question many traders ask from themselves. Why did the market move against me if my setup was perfect? The truth is, no trade is 100% certain or guaranteed. In trading, we are in the market, and the market is based on the probabilities. Even the cleanest technical setup can fail because macro forces like interest rate expectations, economic data, central bank comments, or even geopolitical events can shift the price direction so quickly. That question helps you move from the frustration to curiosity, which is where better analysis starts. So for just understanding, I took an example here, and as you can see here, we have a very clean setup. We have a strong dynamic support, and our trader opened a long position, but after 6 to 7 candles, the setup failed, and it took around like 40 to 30 candles. This chart is based on the 1 minute time frame. Our trader hit his stop loss. So this is exactly what I said. Most traders only read half of the story and not the reason behind the movement. This bootcamp is about learning to read both the chart and the economic context. So you know not just where to enter, you know the exact reason behind of any single move in the financial markets. That's it. Now let's see and jump to the next chapter, which is about how professional traders enter a trade. So professional traders don't just look at the charts. They combine multiple angles, such as economic data, central bank policies, market sentiment, and then they line that up with the technical levels and the trade plans. The idea is that the chart shows where price is moving, but the economy helps explain why it might be moving. Now here's something which is quite a bit interesting for me actually. I just took an example to compare the old school books about the economy and finance and compare it to the reality in the market. So markets today don't behave like they did 20 or 30 years ago. If you only follow all the school textbook rules, you will probably be confused a lot in different chapters. Amateur traders often look at one data point and assume that they know what will happen. But professional traders don't do that. They ask where we are in the economic cycle. For example, let's say the US CPI reports released higher than expected. An amateur trader might say, oh, inflation is up. Let's buy gold, let's buy NASDAQ. But a professional trader thinks several steps further. The first step is, if we have a higher CPI number, which means we are facing higher inflation in the economy, it may change the Federal Reserve outlook, the central bank of the United States, and then it can change the bond and the DXY, which stands for dollar index, compared to the other currencies, can also be affected. So in this scenario, it can also change the NASDAQ or US 100 price. So the scenario for the professional trader is absolutely different compared to the amateur trader, because the amateur trader setup most probably will be rejected in many cases, because you are only trading numbers and you're not understanding the economic cycle, which is the main part of your analysis. Just to make everything clear, I put an example here. In the old school books, they mentioned when we have higher than expected numbers, we can expect, higher than expected numbers for the CPI or Consumer Price Index in the United States, that we will be diving into that chapter in details in the upcoming sessions. Just to give you an example which makes everything clear here. So in the old school books, they mention when we have higher than expected in the economy, the gold may go higher. But here on 14th of July, I just took this screenshot from the Forex Factory, which we can clearly see core CPI and CPI number, both on the monthly and annually basis, they released lower than expectations. But on the other side, on the right side, the same date, 14th of July 2026 at 1:30 p.m. to London time, as I'm sitting in London, we can clearly see the price of the gold skyrocketed. It means that scenario, which was in the old school books, didn't fly in this case. And that's why I said we truly need to understand where we are in the economy, understand the economic cycle, and then realize what will be the effect of that data and how financial markets are going to react to that economic indicator. All right, so this question is popping up for the next slide, which is who this course is for. So this training is practical for a wide range of people. If you're a trader who relies mainly on technical analysis, like a scalper, forex pair trader, or an index trader, whether you are trading NASDAQ, Dow Jones, S&P, or DAX, or even you are a gold trader, this course adds an extra dimension to your trading. And even if you're an investor who wants to understand macro forces like interest rate, currencies, and the economy, or someone who simply needs a clear view of exchange rates for things like family transfers or payments, you will find this course of use. Basically, if markets touch your life in any way, this course suits you. Now, let's go and see what you will learn during this bootcamp. First, you will learn how to read and analyze economic reports from the main sources, which are from the governments or private markets or private sector, let's say, in the United States. Not just the numbers on a calendar, but how to get the actual government report, break it down and interpret what it really means for the markets. Second is about the news trading strategies. You will learn how to approach major economic events and what to avoid and how to manage the extreme volatility during the news. The third one is about the sentiment analysis, because markets are ultimately driven by people's decisions. You will study how emotion and sentiment shape price movements. On the fourth one, you will learn how to use the news terminals like Financial Juice and similar platforms, how to access them and use them effectively to get access to the latest news which released, for instance, 10 seconds ago. The fifth one is about the money management, controlling risk and protecting your capital, whether you are doing day trading or swing trading. The sixth one is about the trading psychology and discipline, combining the mental side with the risk control for more consistent results, building a complete trading plan, including backtesting and applying it consistently in the markets. By the end of this bootcamp, you will have a framework that connects economic analysis, market sentiment, risk management, psychology, and a structured trading plan next to a solid technical strategy. That's it. So now we have finished the introduction. Let's begin the first real topic of the course, which is about macroeconomics and microeconomics. Before we learn how economic news move the financial markets, we need actually understand what the word of the economy means. In the simple terms, the economy is made up of all transactions people make every day. Whenever you are buying groceries, ordering a coffee, purchasing a car, hiring someone to renovate your home, or pay for a service, you're actually contributing to the economy of the region where you are living in. So in general, economy means the total transactions and the trades where a people of a specific region are doing can build the economy of that territory. Now we can study the economy from two different perspectives, macroeconomics and microeconomics. Macroeconomics looks at the economy as a whole, or in the bigger image. It focuses on the bigger picture, as I said, and answers questions such as, how is the country's economy performing? Is inflation rising or falling? Is unemployment increasing or not? What are central banks doing with the interest rates? And how fast is the unemployment rate growing? But on the opposite, microeconomics focuses on the smaller parts of the economy. It studies the decisions made by the individuals, household, and businesses. It looks at the consumer behavior, product prices, company decisions, and how supply and demand affect the individual markets. So that now we understood the difference between the macroeconomics and microeconomics, let's connect that to what really moves the financial markets, which is supply and demand. When the economy is performing well, in general, inflation is controlled, employment is solid, and earnings are strong for the corporates and for the firms. Investors usually feel more confident at this atmosphere. In result, their risk appetite may increase. So demand for risky assets like stock, indices, or even crypto market tends to rise, and it can push the prices of these instruments and the symbols to go higher. But on the opposite side, if we have recession fears in the economy, so our investors and our market participants, or even better to say traders, are decreasing their risk appetite, and they are trying to find something safer like gold and other currencies, for instance like dollar or Switzerland franc and so on. So here we have an opposite scenario which can decrease the demand for risky assets. Of course, it's a simplified explanation. In the later chapters and sessions, we will dig into more detailed scenarios. For now, remember, economic conditions influence investor behaviors, and that behavior drives the supply and demand in the financial markets, which can completely affect the price of any specific symbols you are trading. So from this point onward, whenever you hear an economic report or a central bank announcement, don't just think about it's like a news itself. Look at it in this way and try to answer this question, how it can affect the financial markets and how it can affect the symbol which I am trading. All right, that's all for our first session, and see you next session.